Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. This is the first full 5-day working week after many. We're not used to it, but we'll try and manage and pull through. We're coming to you live from the CNBC-TV18 News studios. I'm Prashant, with me my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning. And this is also a week when you have Reliance that comes out of its earnings on Friday evening at 8 p.m.
Aren't Fridays a holiday, Sonia?
We're so used to it, right?
So it's rather a full week, right? I mean, but it was hard. It was hard for so many long weekends to finally come in on Monday and say, okay, guys,
I think
Monday
Nigel has some good
Friday.
news, Nigel.
No, we'll pull through this one. We need to pull through the next, and then we have another truncated weekend. So 2 full weeks, and then
First May, right?
we're back to what we're used to.
And 1st May is a good one. I mean, it's Labor Day.
Exactly.
So, yeah. So you deserve it.
So Labour gets some rest, right? So anyway, let's just quickly run you through what you need to know before we move any further. We are reacting to 2 days' worth of change as far as the global markets are concerned. The S&P, the Nasdaq, and the dollar index are on your screen. Thursday was good for Wall Street. Friday, we saw some pullback. So adjusted net, the changes on your screen. 1.1 higher on the S&P, 1.6 higher on the Nasdaq. And the dollar index is absolutely flat. I mean, Thursday and Friday kind of nullified each other. So the backdrop is positive in that sense. I mean, it's not bad at all, the global backdrop, that is. The problem is that we've got a bunch of earnings to deal with, which were not all that great. Infosys reported numbers on Thursday after market hours, and numbers disappointed. This is going to be a big topic of discussion through the course of the next 2.5 hours or so. The ADR cumulatively over Thursday and Friday sold off 11.2%. Now, Infosys has around a 7% weight in the Nifty. That's a large weight for a single stock, and presumably it will start with a large cut this morning as we open. And that perhaps is going to be the big drag that you need to watch out for the Nifty itself. I'll get to the SGX and what it is indicative of in just a bit. But the Nifty by itself, right, has been up for 9 days in a row. So it's been uninterrupted gains, even on Thursday when it looked like the market's going to pull back, see that eventual kind of exhaustion and maybe consolidate. We ended higher. The Nifty, I mean, there was a sharp recovery from the day's low. The immediate resistance then in that sense for the Nifty becomes the 50% retracement of the entire fall from the all-time high. That stands at 17,858. That's about 20-25 points away from where we are right now. That's the immediate resistance. Only on a decisive close above the 17,858 level, we get to the next important retracement, which is the 61.8% retracement. That stands at 18,100. But I think on a day like today, with what the SGX is indicating, etc., what one needs to watch is also support levels. On the downside, the support for the Nifty comes in at 17,650. That's the number that the market needs to defend. Now, Bank Nifty also saw follow-up buying on Thursday. Out of the Nifty and the Bank Nifty more recently, Bank Nifty has been the stronger of the two indices. It's already, by the way, above the 61.8% retracement. The Nifty is not even at 50, but the Bank Nifty is above the 61.8% retracement of its entire fall. That level is 42,036. So, for the Bank Nifty, a defense of this number becomes important. That's the first level to watch out for. And then you've got 41,280, which is the next support, which perhaps will need to be held as we open this morning and go into the next couple of weeks, next couple of days as well. The SGX will come up on your screen. It's indicative of about a 90-odd point fall, which will take us to about 17,780. That would still leave you in a pretty good place after the 1,000-point rally that we've had, in the last 2 weeks or so, 2.5 odd weeks or so. So only, another 100 points from where the opening is being indicative by the SGX, I think you'd need to start to worry, which is, that 17,650 kind of levels, which I think we'll see if we need to get to and talk about those kind of numbers. The uptrend has been very, very nice. And as we've been saying towards the end of last week as well, maybe, you need to just pause a little bit, catch your breath before you decide on the next move. It's been a full 1,000-point move, 3,000-point move on the Bank Nifty, from the lows that we saw just 2.5 weeks back or so. Infosys does no good for the market. HDFC Bank also, by the way, has not really done or is not pulling its weight because of the numbers, which are not subpar, but largely in line with expectations. Sonia.
Oh, absolutely. I mean, even adjusted, right? If you think of it, SGX Nifty is now down about 100 points. So the start is definitely going to be quite weak. And it's two reasons, right? The weak earnings from Infosys and weak global cues, which are going to have their bearings on the market. And that's the big question that everyone's asking. If companies like Infosys and TCS are reporting these kind of subdued numbers when the economy is still okay, what happens when the US markets go into a recession? At that time, does it get worse from here? So this lack of visibility is something that has caused multiple downgrades post-Infosys earnings. Nomura, CLSA, you name it, have cut their target prices, cut their earnings estimates. So that's definitely going to be a drag on the market. Also, the guidance for FY24. So it's the first instance of a tech company giving us, of course, Infi and TCS giving us a sign of what FY24 could look like for the industry. And it's just a 4 to 7% growth that we're staring at. So that's something that could drag the entire sector down with it. In fact, there are downgrades on Tech Mahindra as well this morning from the likes of Citi. We'll talk about that in greater detail. Apart from that, the global macros are not looking too good either. The retail sales data didn't look so good. In fact, it declined by 1% last month in the US compared to an expectation of a 0.5% decline. So that sort of dragged down the US markets with it. For our own markets, though, something that the street could perhaps latch on to is HDFC Bank's numbers. They were a decent set of numbers, no great complaints. Of course, little niggling worry here and there, but largely the numbers are intact. The net interest income growth of about 24%. Retail loan growth was very strong, almost a 30% growth. So that's something that the street may perhaps latch on to, the bulls may latch on to. It's a big week of earnings. In fact, it's a big fortnight of earnings. You have Reliance Industries on Friday, you have ICICI Bank on Saturday. Next week, you have a lot of auto numbers coming out. There's Bajaj Auto, Maruti, etc. So all eyes will be on that. And for our own markets, right? I mean, Nigel will talk about that in greater detail, but it's been gains that the market has seen for 3 consecutive weeks. And FIs have been buying in the cash markets for 10 days now. So the question is, do we pause here because of weak earnings from the tech majors as well as weak global cues? And does that dip get bought? Because the market has been on an uptrend. But does it uptrend see a bit of a pause? Time will tell. Of course, IT earnings would be top of mind.
Well, that's right. Can the Nifty make it 10 sessions in a row? Remember, we have not seen this all the way since October 2020. Our digital team, we have Hormuz, who had put out that alert the other day as well. So that's going to be the big question. Now, you look at the Nifty futures and the SJX Nifty, because you'll be wondering why we are saying that we're going to see a pullback of around 80 to around 100 points, because you compare both of them. And that 100-point downtick will be bang in line with the lows that we saw on Thursday. So let's see whether or not that dip gets bought into. The big question today is the buy on dips thesis. That's going to get tested. It's played out very, very well. But today that gets tested, and you have 2 large names, Infosys and HDFC Bank. Both of them will react to its numbers. We're talking about 16% weightage on the Nifty that reacts to its numbers. The FIs, they have been showing us the money since March 27. They seem to have turned the corner, and for 10 straight sessions, they have been buying in there. The FIs, well, on the index futures, well, the long positioning was up by close to around 5,000 contracts. They covered close to around 8,000 short contracts. And just take a look at it, the net short contracts, I'm talking about the shorts minus the long positions, from more than 1 lakh contracts, that's come down to less than 30,000 contracts. So in a span of 5 sessions, you have the FI net short positions that come down to a third. That's telling you the kind of ferocity in terms of short covering that we have seen out there. On the options data, the 17,800 put, well, that added close to around 30 lakh shares. Now, that's a sizable number, actually, because effectively, the open interest went up by close to around 3 times. From around 15 lakh, it went close to around 45 lakh odd. So aggressive writing is what we're seeing out there. And just plugging in that number, well, we have our first support level at around the 17,710. I say that because of the writing we saw at around the 17,800 put. And the 17,730, that's the low that we saw on Thursday itself. If that level gets break or that range gets broken, then we're looking at support zone of around 17,550. The 50 and the 200 DMA comes in at that level, and on the upside, the 100 DMA that remains elusive, at least as of now. The Nifty Bank as well saw a good amount of open interest build up, and there was writing being seen at around that 42,000 put in an uptrending market. So effectively, the open interest out there went up by close to around 20 times. Since we're seeing writing out there, the 100 DMA becomes very, very important, because on an average, the premium out there would be around 300 rupees odd for the 42,000 put. So 41,700 becomes crucial. SJX Nifty is suggesting a bit of a downtick. The buy on dips thesis gets tested, and let's see whether or not we can recover at some point of time from this 80 to around 100-point downtick.
Okay, it looks a bit tough, right? Given that you have so many big earnings this week as well, and there could be a lot of negative surprises too. But give and take everything, this market has done quite well for itself. I mean, it's up over 5% from the lows that we saw in the month of March. But lots to talk about. It's a full week, lots of cues as well. So let's kickstart very quickly with a view coming in from Chetan Seth of Nomura, who says that softer US data in the months ahead is a risk for stocks. However, the exact timing of the slowdown is clearly uncertain. So long as the US data continues to hold up, stocks are likely to be well behaved. They, however, do not expect a meaningful decline in Asian stocks in their base case. And if there is any weakness in Asian stocks due to US recession concerns, it will be an opportunity for investors to raise exposure. In India, Nomura has removed Infosys after results disappointment and analyst downgrades and replaced it with a mix of relatively defensive names like IGL, HUL and Bharti Airtel. They've also replaced Sona BLW with Uno Minda.
Well, get you some money market views as well. This is B. Prasanna of ICICI Bank, who says that the dollar weakened throughout the previous week on softer inflation and retail sales data, but staged a recovery and consolidated towards the end owing to better consumer sentiment. The rupee, meanwhile, has an appreciation bias, aided by a soft dollar outlook, improved balance of payment outlook, exporter hedging and capital inflows. Prasanna says that the RBI is likely to smoothen any volatility. He expects the dollar INR pair to trade in the 81.40 to 82.40 level. That's the range that he expects this week.
All right, and on the bonds, B. Prasanna of ICICI Bank says global yields drifted higher as central banks continue to retrade higher for longer theme. Despite growth data coming in on the softer side, domestic yields got support from positive inflation print amid supply pressures resulting in range-bound movements. Prasanna expects the bond market to trade sideways as there are no events lined up, and the 10-year bond yield is expected to trade in a range of 7.10 to 7.3% today.
Well, that's how trade setup is, equity calls as well as money market calls. But we have a lot of stock-specific action that we're going to be tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at HDFC Bank, Network 18, TV18 broadcast. You have Z Entertainment, Max Healthcare, Adani Green, Vartech, Varbag, Sartha Energy. Their stocks on the back of positive news flow. While the big boy, Infosys, that's going to be dragging the index today. That's expected to open up, with a deep downtick. And GTPL Hathway, that's the other one that could be reacting to its results as well.
All right, Richard Harris is joining us, Chief Executive Officer of Port Shelter Investment Management. Richard, good to have you with us here. Thanks very much for your time. You know, we had a lot of US banks which reported numbers and pretty much solid numbers, right? So this should once again allay any fears that the banking sector, which is at the heart of the financial sector in any country, is in any trouble at all. If that is true, then will the market have to reprice their own expectations of what the Fed will do, because they don't have to worry about banks and the financial sector in that sense?
Well, I think what's happening with the banks, as with all of these numbers, is that, we're looking at through the rearview mirror a month or two back. What we've seen is obviously yields rise. Banks haven't really raised their deposit rates, so obviously their margins are going to widen. And you've seen, especially with some of the major US banks, that earnings look pretty good. And also don't forget that you've had a lot of deposits flooding out of smaller banks into the bigger banks. So the bigger banks have done well as a result of that. I think we need to be cautious about the banking sector. It's the area of the market where you first see non-performing loans and stress happening. Against that, of course, we now have the situation where clearly there's some kind of put going in. Authorities, not just in the US and around the world, as we've seen with Credit Suisse, are going to support banks. They're not going to let banks fail, because it's people like you and I who get affected by that. So banks are in a rather special position. So I think we are in a situation where, yes, we may see more runs on banks. We may well not see them because people know the authorities are going to support them and stand behind them. But I don't think the bank results actually foresee any real improvement in the markets.
Okay, that's about the banks. But what about the overall equity markets? I mean, the Indian market has had a fairly smooth run. We've seen a recovery of around 5.5% from the lows that we saw in the month of March. Do you think that pullback is something that can continue? I ask because we could be heading into a global recession as well. What happens then?
Well, I think that's right. I see this as being relatively short term. I saw one of your correspondents a little bit earlier was maybe a little bit more bullish than myself, but I am cautious. I think we're in a period of volatility. Yes, the market will go up 5%, but it'll probably also go down 5%. If we see recession, that's going to be negative, but we're probably going to see it first in the US and Europe. And maybe rather later, say somewhere like India is likely to be affected by orders. But I think you're going to be pretty brave, I think, to dive into the market unless you're an out-and-out short-term trader.
Hi, Richard. Good morning. How many more rate hikes are you factoring in from the Fed, in 2023 itself?
Well, over the weekend, we've had words from both Jamie Dimon, head of JP Morgan, and Larry Fink, who's head of BlackRock. Now, those guys look over trillions of dollars of assets. So you have to look at them pretty seriously. They both think interest rates are going to go up. It's fairly clear that certainly where I'm sitting, if I go into the supermarket and just what we're looking from data, that inflation is here. It's very sticky. It hasn't yet got through to the major population, except maybe in utility bills and things like that. And I think we're just going to get a continuation of the wage spiral because people have to have more money to pay their costs. Then companies are going to be concerned because their costs are higher. The big metric to look out for, I think, in the West is unemployment rates and where labor is actually going to go.
But just, Richard, just as you said that bank earnings were reflective of what has already happened, right? One can argue, many actually do argue that the CPI numbers are also exactly that. They're telling you what has already happened, not what is likely to happen. So would you want to respond to that?
Well, of course, that's the worry. And what we have at the moment is, we saw inflation start to go up because of COVID. Inflation was high last year. We've now got the base effect where it appears that inflation is coming down, on a year-by-year basis. But don't forget that in many Western markets, they're coming down to 5%. In Europe, they're coming down to 7, 8, 9% from higher levels. But those figures are substantially more than they were, say, 2 years ago. So there's going to be some catch up in the system. And I think what we have to be very careful is that all of these cycles, the interest rate cycle, the inflation cycle, the employment cycle, the consumer cycle, the economic growth cycle, they're all moving in different directions at the moment. And that's increasing the complexity for analysts to actually see what's going on.
So where do you put your money then? That's the big million-dollar question, right? If you have money to spare in a market like this, if you're cautious on India, you say that this is not the best time to be investing. Do you stick to cash? Do you put your money in alternate assets like debt or even, perhaps real estate? What's the asset allocation strategy now?
Well, as an investor, you can't run, you can't hide. You've got to be in something. I still think selective equities look pretty good. Things like consumer durables. I still like areas like the tech. I mean, if you're looking as a foreign investor looking at India, I think you have to see, what does the economy really do quite well? Things like generic drugs. I know you're talking about Infosys, but these companies are going to be hit with the J curve. But eventually, foreigners are going to be looking at those kind of counters because they're the counters, I feel like, that represent India to foreigners. So I think certainly as an overseas investor, you need to look at those kind of things. What makes up the country if you're going to invest there. And I think you have to also maybe have some cash and maybe even a little bit of gold in your back pocket because this is the environment where, it's volatile. Things may not go up. Things may well go down and cash can be king.
All right. Very quickly, Richard, before we let you go, toss up between India and China. I think the last time we chatted, you were more inclined toward China. How do things shape up out here?
Yes, well, I think what's happened, not only to me, but to most people looking at China, is we've been really very surprised by the fact that they haven't seen the significant rebound that we actually saw in the West and in other markets too, as the COVID restrictions came off. It's been much more muted. I think one of the reasons for that is people over the space of maybe 2.5 years have got very, very cautious. They don't want to dive in. They don't want to invest. They don't want to spend because they have been stopped so many times. So I think that there is a reluctance there. I think China will continue to recover and the figures will continue to do better and better, but at a much, much slower pace than was expected from around the rest of the world. So on that basis, you're probably back to maybe a more neutral China look if you're looking between the two, but still possibly favoring China for that little bit of extra upside.
Okay, possibly favoring China. Got that. I mean, we don't like it that much, but it is what it is, right? Thanks a lot for joining us.
It's all cycles.
Absolutely, market cycles. No one can help it. Thanks a lot for...
And it's good to see Richard on the camera, Richard. We usually have you on a phono placard, so this is much better.
And I have to put my tie on as well.
Sorry, I missed that.
Had to put the tie on.
I have to put my tie on too.
Is that your home, Richard?
Absolutely, yeah.
Okay.
Yeah.
Some of us are still lucky to work from home, right?
I've got to scrub up for you guys if I'm on camera.
Sorry, I didn't get that.
I have to scrub up for you guys if I'm on camera.
Yeah, absolutely. You have to. I mean, some of us are still lucky to work from home, right? That's a good thing. Yeah. Anyway, we'll speak to you again very soon. Thanks a lot for joining us on CNBC-TV18. Okay, so that's Port Shelter Investments talking about how they're still a bit cautious on the markets, and this is perhaps not a great time to be investing. There could be a period of volatility. Let's slip into a quick break, though. Lots of stocks to talk about. Infosys, of course, top of mind. Our entire research team will be joining in just a bit. Welcome back to Bazaar Morning Call. This morning, the SGX Nifty is suggesting that the start will be in the red, down about 100-odd points. It's Infosys that will be the big drag. So Rima is joining in to tell us what went wrong this time around and what the read-through could be for the entire sector. Rima, I was reading a piece that you had put out where one of the analysts was saying that if this is the situation now, that companies like Infy and TCS are reporting weak numbers, God knows what happens when the recession hits the US. But just tell us what are the numbers looking like and what are brokerages saying?
Well, let me start with one number, the Infosys ADR and how it's performed post the results. Infosys ADR was down nearly 10% on Thursday, and it followed it up with a 1.5% cut on Friday, which means in a span of 2 days, it's a cut of more than 10%. And remember, Infosys is an overweight holding for most institutions, foreign or domestic. The mutual fund holding in Infosys is the highest amongst peers at close to about 18%. The FPI holding is close to about 36-37%. Most institutions prefer to hold an Infy over a TCS. One, because the float was higher. Two, it was relatively cheaper compared to TCS. And third, Infosys was growing faster than TCS. For the last 4 years, Infy growth rate has been more than TCS. This is one of the reasons why Infosys was widely held. And now that could be the bane for the company. Consensus EPS estimates have approximately been lowered by 7 to 8%. Big miss on all fronts. This time, revenues have fallen by 3.2% on a quarter-on-quarter basis, and margins have shrunk by 50 basis points. The reason is that there were unplanned project ramp downs, not just in BFSI, which of course we know is a problem area given the headlines, but even in other verticals like retail and telecom. They also had some project cancellation, something that TCS did not have. Their FY24 guidance is muted because of the uncertain environment. So they're only guiding for a mid-single-digit kind of revenue growth next year, 4 to 7%, and margin guidance too is lower compared to what it was in the year gone by. So margin guidance for next year is 20 to 22%. This, as I said, was a consensus overweight for brokerages. Most of the analysts had buy ratings, overweight calls on Infosys, and now you are seeing big downgrades. CLSA has downgraded it to an outperform. Nomura has downgraded it to a neutral. JP Morgan, we know, has been underweight on technology for the last couple of months. They further downgraded Infosys to an underweight, and Citi now has a neutral call on the stock. Back to you.
Okay, thanks a lot for that. Well, Sumit Jain of ICICI Securities and Moshe Khatri of Wedbush Securities will also be with us in a short while to tell you what you should be doing in case you have Infosys on your list or in your portfolio. But the other big stock in focus is HDFC Bank. The numbers look decent actually this time around. The retail loan growth was very strong, almost 30%. Abhishek is here to give us details on that. Abhishek, morning.
Morning, Sonia. So the bank is building itself for the future traction in terms of business momentum, and hence the costs are being incurred right now. However, the quality remains impeccable. So what has worked in this result is that despite the rise in cost of funds, net interest margins have remained stable on a sequential basis, and the NII growth on a YY basis is very strong. If you look at the slippage ratio of close to 1.2% is perhaps the lowest in last 6 quarters and second lowest in last 31 quarters. So the asset quality that remains impeccable given the fact that gross NPA ratio is the lowest in last 9 quarters and one of the best in the industry. ROA remains robust at more than 2.1% with PCR or provision coverage ratio now being above 75%. So the RWA to advances ratio, a measurement which shows what kind of risk is being built in the balance sheet in terms of the growth coming in, that is the lowest in last 4 quarters and second lowest in last 17 quarters or even more. Restructured book is at a mere 0.3%, perhaps the lowest that you are seeing in last 10 quarters. And HDB Financial, they reported their highest ever quarterly profit with asset quality or the gross NPA ratio being the lowest in last 9 quarters. On the flip side, what has not worked is that the OPEX remains elevated due to branch expansion. So the cost to income ratio of 42% is perhaps the highest that you are seeing in last 25 quarters. CASA growth rate is below the deposit growth rate, and corporate loan growth that is also below the overall loan growth. So PNL, both in terms of NII and PAT, is below our poll. Back to you.
All right. Thanks a lot for that, Abhishek. Well, and we have Digant Haria of Greenedge Wealth Services who will be joining in at around 9:05 a.m. to decode those numbers as well. Let's focus on a couple of other names. Z Entertainment, that's going to be the big one in focus today. Vivek joins us to tell us more on that. Vivek.
Well, good morning. Z Entertainment, large block deal is anticipated to occur, in today's trading session. So Oppenheimer is looking to completely sell out its 5.65% stake in the company via a block deal. Now, what we understand is that the offer price range for this particular block deal is at 199.8 to 208.1 fair. Now, what we understand is, from the term sheet, this is a complete clean out trade from Oppenheimer. We also understand that, the demand for this particular block has been quite robust. The total offer size for this particular block deal stands at a little over 1,130 crore. So watch out for Z, could be a sharp mover in today's trading session.
All right, thanks a lot for that. Well, TV18 and NW18 are in focus as Viacom18 has announced the completion of its strategic partnership with Bodhi Tree and Paramount Global. Surbi is here to give us the latest on that. Surbi, over to you.
Thanks for that. So TV18 and Network 18 both will be in focus today, and that is because Viacom 18, a subsidiary of TV18, over the weekend has announced the completion of strategic partnership with Bodhi Tree and Paramount Global. Now, post this deal, Viacom 18 will own the JioCinema OTT platform. The completion of the deal was on expected lines after it was announced last year, but there are two interesting aspects to this. Firstly, some of the contours of the deal have changed. Initially, out of the 15,145 crores which were to be invested, Bodhi Tree was going to invest the 13,500 crores and the rest was going to be invested by Reliance. But now Bodhi Tree is contributing 4,306 crores and the majority is going to be contributed by Reliance. Now, post this deal, Reliance and the group entities will hold 60-odd%. TV18's share will be 13.5%, and both Bodhi Tree and Paramount Global will hold 13% each in Viacom 18. The second interesting aspect is the valuation. Based on the Bodhi Tree's investment, the suggested valuation of Viacom 18 is close to 33,000 crores. TV18's share in this would be 4,457 crores, suggesting that the residual value of TV18's business is close to 700 crores, giving it a significant upside from its current levels.
All right, thanks a lot for that, Surbi, and that's a disclaimer as well that comes up for you on the screen. Ekta joins us to wind it down with all the stocks that she's focusing on. Morning, Ekta.
Hi, morning. Well, I'll start with Max from the hospital space where they've acquired additional 34% stake in Eqova Healthcare for 69 odd crores. Now they hold 60% in that particular arm. And they have an agreement with a charitable trust, which is basically to develop and provide medical services to a 400-bed hospital. So that's the outcome of it. Adani Green, the total operational capacity has increased by 49% year on year, which is now the largest in India. They've commissioned a solar wind hybrid power cluster in Rajasthan. They've also commissioned a wind power project or plant in Madhya Pradesh. Pradesh, as well as a solar power plant in Rajasthan. VA Vabag is in focus lastly because they've sold a subsidiary company for around 45 odd crores. So all these stocks, I expect them to probably see some amount of upside in today's trade.
Okay, thanks a lot for that. But there are plenty of other stocks that are in the news this morning, and Surbhi has the lowdown for us. Surbhi, over to you.
Firstly, for GTPL Hathway, they have reported their Q4 numbers and the numbers don't look so good. Even though the revenue did see a 13% growth on a year-on-year basis, which was largely led by the broadband segment, which was up 13%, and the digital cable segment, which was up 2% on a year-on-year basis, it was their EBITDA which took a big hit. EBITDA was down 17% at 102 crores, and the company saw a margin contraction of close to 500 basis points. The EBITDA margins came in at 15% versus 20% same time last year. It also reported a loss of 11 crores versus a profit of 57 crores same time last year. Next on my radar is Sardar Energy, where the Indian Bureau of Mines has revoked suspension of mining operations at the company's iron ore mines. So positive news for Sardar Energy.
Okay, thanks a lot, Surbhi, for that. Well, let's do a quick recap then in case you missed out on any stocks. Positive news flow coming in for HDFC Bank, Network 18, TV18 Broadcast, Zee Entertainment, Max Healthcare, Adani Green, VA Vabag and Sardar Energy. While stocks with negative news flow, of course, Infosys, top of mind, and GTPL Hathway as well. But also, let's get a handle on what's happening in the world of commodities. All the action overnight and in the last 48 hours. Manisha Gupta is here to give us a breakup of that. Manisha, hi, morning.
Morning. Thank you for that, Sonia. Well, we're trading at a one-month highs for the crude oil prices. We've already gained 8% for the month of April, and we've put behind 4 straight weeks of gains here. Well, the OPEC flagging downside risk to summer oil demand is something that's weighing onto the markets. But on the other side, it clearly is about Chinese demand coming back with a bang. IEA says that they're looking at record demand forecast for this year, and the markets now are waiting for the China first quarter GDP data that comes in tomorrow. The profit-taking, though, has come in for the precious metal prices. After constant gains for the last couple of months now, gold prices fell 2% on Friday and are just about holding that $2,000 per ounce. Some profit-taking on silver as well after hitting a one-year high in the previous week there. An important report from Citi says that they are looking at a higher gold average price forecast of $2,050 for this year. So even as we are looking at profit-taking, most markets or most banks and brokerages believe that you are headed for all-time highs for gold in major currencies this year.
All right, Manisha, thanks very much. Good speaking with you. And we'll have more on commodities in a bit from now. Prakash Devan will join in for some fundamental stock analysis. Later, on the IT discussion as promised, we'll have the analyst from ICICI Securities, and we'll have Moshe Khatri as well join in to decode the fourth quarter numbers from Infosys, the disappointment, what could be the stock impact, and what does it mean for the rest of the sector, which is yet to report. So stay tuned, all of that comes up.
Welcome back. Hope you're having a good Monday morning. Remember, it's a 5-day week, and we're going to kickstart the week with the Nifty actually opening a little bit lower because adjusted. You compare the SGX Nifty with the Nifty futures, and that's suggesting a little deeper gash now, 110-point downtick. But we've got plenty of stocks to discuss, and we'll discuss Infosys in just a bit. But for the time being, let's welcome Prakash Devan, who joins us on the show. Hi, Prakash. We'll discuss Infosys a little later, but I wanted to ask you about HDFC Bank. How do you read those numbers and your view on the stock from here on?
Good morning, Nigel. So I think HDFC Bank numbers very clearly tell you what the bank has been kind of building towards as the potential, merged entity. The foundation of that, the building blocks have been put into place. I think all metrics are good, particularly the retail growth that they've been able to clock. And you can imagine when cost of funds starts getting to be impacted favorably, this entire franchise that they built. And remember, remarkably, they've been probably the only private sector bank that's been expanding a branch network in these times. And they've used technology to the hilt in terms of making branches very effective, very, fully, efficiently utilized. And that's what's kind of started to reflect in the numbers. I'm extremely positive on this. When you compare it with an ICICI Bank, which was growing so rapidly till, let's say, about late last year, or even Axis Bank, which has its own triggers, I think this bank stands out again from a value perspective and from a momentum perspective also. Very rarely you see that in a large entity like HDFC, but that's what's going to happen. So extremely positive. People who don't have it in the portfolio yet, surprisingly, there are people who still don't own it. They'll probably start looking at it at least to start adding into the portfolio at this point in time. We'll get too late otherwise in terms of the realizations when the merged entity starts kind of playing out.
All right, got that. IT is definitely going to be in focus as well. So, Prakash, just stay on for a bit. We need to discuss Infosys numbers too. This is the first constant currency revenue decline that Infosys has seen in the last 10 quarters. So, definitely very weak numbers. Sumit Jain, the IT analyst at ICICI Securities, joins in. Sumit, I was going through your note where you say that Infosys has a relatively high exposure to the digital transformation agenda of clients, and now that is clearly seeing a delay in decision making. What does this mean for the earnings going forward? Have you scaled down your EPS estimates, your earnings estimates as well? And what does one do with the stock now?
Yeah, no. So basically, we have cut down our earnings estimates by around 6 to 7%, mostly for the outer years. And I think the primary reason for that has been the margin decline what Infosys has seen. And, we believe that this margin decline is basically coming from the mega deals what they have won, and they are not able to recoup the margins back in these kind of deals. So clearly, there is a pressure on the company in terms of recouping the margin back. However, having said that, we have not toned down our constant currency revenue growth forecast for the outer years, which we are still maintaining in double-digit growth. So I guess the near term, there is a bit of a pain, but one quarter doesn't make a trend. And this is where we believe, you have to give a benefit of doubt to the company, given that they have a very high digital transformation exposure. And that transformation agenda took a backseat for the March quarter, where, there were a couple of weeks of impact, particularly after the banking crisis even played out. But yeah, having said that, I guess it is still yet to be seen that the senior management departure at Infy is having any impact on the delivery performance. Because I guess company also mentioned that for the full quarter, they had certain impact on the ramp down of certain projects. So I guess coming June quarter, if that kind of things aren't to be seen, then definitely one can have a view that company is on track. Yeah.
All right. Hi, Sumit. Good morning. Sumit, going by what you're saying, and given the fact that the ADR overnight was down sharply, this morning, Infosys, adjusted, will be down 35-38% from the recent peak, just a year or so ago. For someone who's looking to buy, to build a good portfolio, do you think the stock becomes a buy around these levels, post, say, an 8 to 10% gap down?
So definitely, I think we believe that the stock will be trading at around 19 times 1 year forward multiple. And that will be closer to their last 14-year average PE multiple, 1 year forward PE multiple. And in the last 14 years, other than GFC and the COVID crisis period, there were only a couple of years where Infosys has actually traded at these multiples because of the slower growth environment. So I guess clearly we believe this is, if people are looking for value stocks, then definitely after today's correction, it will give a very good opportunity to buy. Having said that, over next 1.5 months, there could be a bit of a consolidation in terms of a slight derating of Infy over TCS, given that TCS had a better earning growth in this quarter. But this is where I think the June quarter commentary from the companies 2.5 months down the line will be very, very important. But yes, from a 1 year perspective, we would definitely like to recommend investors to add into today's correction.
Okay, Sumit, stay with us. Moshe is also joining in, but I want to just quickly for our viewers play out the commentary from Salil Parekh, CEO of Infosys. My colleague Ritu Singh spoke with him. Listen in.
For the quarter Q4, what we saw is during the quarter, there were some clients where we saw ramp downs, and then there were some areas where we saw one-time situations. The bulk of the impact in the quarter was from the ramp downs that we saw during the quarter. There are two aspects to it. So one, on the ramp downs, there has been with some clients in the telco sector, in the high-tech sector, in retail, and in financial services, in mortgages, asset management, and investment banking. So those ramp downs, we saw some stabilization in March, but the demand environment is uncertain. The way we've constructed the guidance is based on what is the large deal and overall wins we've had in the year and also in the quarter. And then a lot of our work, which is multi-year work, that carries through. So based on that, we've also expanded instead of a 2-point guidance, which we normally give, we've done for a 3-point guidance, more with a view that the environment is uncertain given what we saw in Q4. There, as we've said in the past with large deals, the timing is not like a predictable thing when they come in a year or it's going to come every quarter or something. But over 1 or 2 or 3 year periods, you see this thing shows more stability. There is slowing in decision making for large deals. So the time, let's say discussion or deal is in a pipeline becomes a little bit longer. Has been, we've seen the data. But when the decision is made, it starts right away, and that translates.
Okay, I mean, there is, with IT company earnings, I remember 15 years ago, there used to be this constant thing about body language. I mean, body language of IT companies and this, So body language is a real thing. Salil's body language was muted, right?
On the back foot.
He's out there getting it done kind of a guy, and it did show. I mean, the numbers speak for themselves, and he's done a fantastic job, absolutely no doubt, since he took over. And I think this is the first quarter where there is a bit of a hiccup. Moshe Khatri is joining us, Managing Director at Wedbush Securities. Moshe, good to have you with us here. Thank you very much. What did you make of the Infi numbers and your own assessment? Is it, so Sumit was saying that we'll get a big correction. We will. And then after that, maybe it gets into a Bible kind of zone. What's your own assessment?
I think we're in a very unusual situation. On one hand, the budgets are here. On one hand, you've seen at least TCS come out with very strong bookings for the quarter. On the flip side of it, we knew kind of early March that the situation is going to be fluid in terms of decision making and pipeline conversion. What's interesting is that the speed at which projects were deferred, kind of shows you that things can get turned on pretty quickly as well. And that's why it's kind of an unusual situation. And it almost is a call on the global macroeconomy. We've had, the four large banks reporting in the U.S. on Friday. Numbers actually look very healthy. So, you almost have to make a call on, clients, psychology in terms of their propensity to spend more than anything else. It's not a very similar situation to the 07-08 timeframe, for example, where banks had structural issues because we're not here yet. And that's what makes it really tough to kind of take a look at some of these names. We took numbers down early March, probably not enough. And I would say that the earnings misses for both TCS and Infi were predominantly a function of utilization rates. People sitting on the bench towards the end of the quarter. And this could be adjusted pretty quickly if these companies want to, in order to preserve margins. So I think we're kind of as I said, it's a very fluid situation, and it seems that this is going to be more of a back-end loaded year than anything else.
Okay, it's a fluid situation. Moshe, hi, good morning. What also stood out for us is that while TCS said that there are project, deferrals, they've not seen any cancellations just yet. But Infosys coming out and saying that there are ramp downs, there are cancellations in certain cases as well, just brings us to the question that in the near to medium term, is there a case being built for TCS to perhaps outperform Infosys just based on the commentary and the numbers that they posted this quarter?
It's a possibility. I think a lot of this is going to be a function of the intra-quarterly updates from these companies. If things stabilize, or are we going to see some more releases of funding for projects? Based on that, they'll kind of determine, based on the feedback, we'll kind of determine where both of these companies go. But remember, the spending environment is going to be, relevant for everybody. I don't think anybody's fully shielded here. And that's why I kind of call this a fluid situation.
All right. Thanks so much, Moshe, as well as Sumit, for joining in and giving us view on the tech space, in particular, Infosys, as well as TCS. We look forward to chatting up with you rather soon. But let's get back to a conversation that we're having with Prakash Sivan. Prakash, since we're talking about TCS and Infosys, one positive is both of them are saying that attrition will cool off from here. How does that place Info Edge? Because if attrition is going to cool off, it may not be very good news for them, right? Any view on that stock?
I think more than just attrition cooling off, generally the slowdown in hiring is so largely evident. And I don't see Info Edge gaining from that. In fact, the only thing that could revive them is of course, there's a very small residual stake in Zomato, but if things look up there, that's probably going to be a bigger spark than the core hiring activity. But my sense is IT will probably reset itself in another 6 months, Nigel, in terms of what kind of projects, what kind of businesses start doing well. The mid-sized plays could probably start being more promising, and that's more domestic oriented. So you never know. But at this point, Info Edge does lose its luster of sorts, given what's happening to the large IT majors.
All right. Let's do one thing. Let's take a quick break on that note. We have a lot more to talk about. But on the other side, we'll also tell you how to focus on the market, given that we have weak Infosys numbers, weak global cues. Do we get start on the back foot? And what do we do from there? Mitesh Thakkar, Sudarshan Sukhani will be joining in for some technical trades. Stay tuned.
Okay, welcome back. You're with us here on Bazaar Morning Call. Just about 10 minutes to go for the pre-open session to kick off. The SGX indicating a 90-95 point cut. How much of it is Infosys is the question, and how long lasting is that damage going to be is the other one. Imponderable right now. Anuj is here with a quick trade setup. Anuj, hi, morning.
Morning, Prashant. To answer that, if Infosys falls 7%, that drags Nifty by 95 points. So
entirely.
As simple as that. So entirely. But normally, if you have gap down in uptrend, that is bought. And of course, you will have reaction to Infosys ADR, which is indicating about almost 6 to 8% fall. HDFC Bank, on the other hand, the numbers were quite decent. But since it's positioned so strong, my sense is HDFC Bank could also fall in trade today, at least for starters. But Bank Nifty is stronger than the Nifty. And there's been quite a bit of FI buying and short contracts down to 29,000 now from peak of 1.94 lakh. Just to explain this HDFC Bank Infosys impact on the market, HDFC Bank's weight is 10%, Infosys weight is 7% in the Nifty. And as I said, if Infy opens 7% down, it drags Nifty by about 90 points. So all of SGX loss is because of Infosys. On HDFC Bank, market may still want to give benefit of doubt because of late the market's been focusing more on balance sheets of banks rather than the P&L, and balance sheet remains quite strong. On the Nifty, normally dips are bought in uptrend. There's been huge build-up at 17,800. The premium is 60 rupees. So support zone for the Nifty is 17,717 to 17,730. That is basically the low points of last 2 days. And if there's buying at lower level, that will face resistance at 17,825 to 17,842, which is the high point of last 2 days. But you know what? We need to focus on the Bank Nifty, and over there, need to see market's reaction to HDFC Bank, because the Bank Nifty is overbought in the near term, and it needs some reaction. It may happen today, and according to options, the base on Bank Nifty is somewhere around 41,800. So there could be some consolidation, but if 41,800 holds, maybe there will be another attempt to sort of buy and take Bank Nifty once again past 42,000. But we will see how the market reacts, of course, in the opening tick, and then take it forward.
Okay, Anuj, thanks a lot for that, and a long week coming up. So let's get Mitesh Thakkar and Sudarshan Sukhani.
A normal week.
A normal week, yeah. I don't know what's normal anymore. We were used to so many long weekends.
Yeah, and by the way,
that became normal for me.
Yes, by the way, if you thought this Monday is crucial because you're reacting to two big numbers, next Monday, I dare say, even more important because you'll be reacting to Reliance and then ICICI. which is on Saturday.
Yes.
Thanks for that, Anuj.
Yes.
So, a lot of work, not just on the week, but on the weekends as well.
Absolutely.
ICICI Bank on Saturday. Got it. 20% of the Nifty components, by the way, will be reporting their Q4 earnings this week. So it's going to be a solid week for us. But let's get some help in from Sudarshan Sukhani and Mitesh Thakkar. They're going to help us with how to trade today. Sudarshan, let me start with you. Given that, we might start on the back foot with infees numbers, the global cues, etc. Would you buy the dip or would you wait a bit and watch?
Good morning. Well, Sonia, if I, as a swing trader or a positional trader, I'm willing and waiting to buy dips. So today's dip is an opportunity to go long for anyone who has missed the bus or is currently not long. Your stops are 17,600 approximately, which is the next support level for me, for swing traders. And wait patiently for the first few minutes, which is the cooling off period. Buy the dip and forget about where the Nifty goes. So far, it's above 17,600. It's a good trade to be in as a long trader. Now, for intraday traders, obviously, the story becomes a little different. But here also, you should wait for stability and look to go long. It's not a good idea to go short in a market that's gapping down and is in a bull phase. So for both kind of traders, the trade would be to look to go long.
Mitesh, hi, morning. What about you? How are you going to approach things?
Morning, Prashant. Again, I think, we have been advocating booking positions on the Nifty around 17,780 levels and have nearly exited the index long positions. But yes, I think the trend is on the upside very clearly. Having said that, a gap down would be a welcome chance to explore long positions again. And my preferred buying zone is closer to about 17,670, 680. And 17,650 will then automatically become the, or just below that will become the stop loss level for me. These are spot levels. So I think very clearly, given the fact that the trend is up and we are slightly overbought, pullback would be a welcome opportunity to get into longs again on the index with a stop below 17,650.
All right, looking to buy the dip. That seems to be the trade today. Mitesh, what about individual stocks? What are you looking at?
Morning, Nigel. I have a mix of buy and sell calls today. On the buying side is Canara Bank if it starts getting past Thursday's high of 291.5. So buy about 292 with a stop below 286.5 for targets of 305. Sell on HPCL with a stop at 230 for targets of 215. A sell on Birla Soft with a stop at 268.5 for targets of 252. And a buy on Navin Fluorine. It was buy earlier as well last week on a couple of occasions. Even now can be bought. Keep a stop below 44.80. Look for targets around 46.50.
Okay, and Sudarshan, how about you? What would your strategy be on individual stocks?
See, this is a buy on dips day, so I'm looking to buy the dip. Axis Bank is a buying opportunity. The stock has a wonderful chart. It's built a large base on the verge of breaking out. If it doesn't break out today, it'll break out tomorrow, I think. So just buy it a little lower if it is possible. Stop under 840. Birla Soft is my only intraday short. Even Mitesh had it. I think we're seeing the same charts. Intraday short with a stop above 266. Hindalco is another buy. Again, Hindalco has been a distinct underperformer. It was in a mini bear market. That seems to be coming to an end. I always like to buy good quality stocks when they are just emerging from the dump. That looks like Hindalco. Buy with a...
Yes. Go ahead. We can hear you.
Hindalco is a buy with a stop under 408. And ONGC is a buy with a stop under 152. It's on the verge of a breakout on the upside.
All right, thanks a lot for that. So that's on ONGC and Hindalco. ONGC on the verge of a breakout on the upside. Let's take a short break. When we come back, we'll just have a few minutes before the pre-opening rates kick in. We'll also have Digant Tharia of GreenEdge Wealth to discuss the Q4 numbers of HDFC Bank, the performance, the way forward for the stock. More on that in a bit.